This is Trading Day, live.
Welcome to the program. It's a Thursday afternoon. I'm Nadine Blaney. Let's check in on how this Australian market is faring. In 2 hours of trade, we're down by about 0.75%. The All Ords off by 43 points as well. Taking a look at some of the sectors, we have materials and energy space really weighing on the market overall. Australian energy plays as a whole down by about 2%. So yeah, pretty strong headwinds flowing across this market today. Well, Murray Goulburn shares slide following reports the ACCC still has issues with its sale to Saputo and Orica. Well, it's shutting down 2 of its operations, unexpected maintenance, and shares in the company are down by about 3.6%. We are watching mineral resources today as well. Also making news is our China-owned coal play Yancoal finally turning a profit for the full year. The improved result following its purchase of Rio's Hunter assets last year. And in economic news, headline fourth quarter capex retreating by 0.2%, but an uptick for plant and machinery spend coming through. More on that later in the half hour. In fact, we'll be speaking with Dave DeGaris from the NAB in Melbourne. Well, joining me in studio today is Adam Dawes. He's from Shaw and Partners, and Rudy Philippek Van Dyke from FN Arena. Gentlemen, welcome to the program.
Thank you.
So no big surprise to see the market down today, given the lead-in that we had from the US, and a negative session as well yesterday. Adam, a couple of really big companies are trading ex-div as well.
That's certainly going to put a fair bit of weight on the downside to our market. I thought I saw when I left Macquarie was the only one in the top 20 that was up, maybe currency related, but
well, it's trading flat now, so
flat now.
There you go.
So yeah, it was up on the open. So yeah, interesting to see some of these other companies sort of up high. But yeah, certainly, as you say, Nadine, dividends coming out for some of our larger companies, which will put pressure on the index.
Now, Rudy, in your opinion, has it been a rational reaction from the markets when it comes to the testimony that came from the US Fed Chair Jay Powell, and in anticipation of more coming through tonight?
There's a public discussion going on which remains undecided so far, but I mean, on my observation, I think the market is a lot less uncomfortable than a lot of commentators want us to believe. I mean, there's a lot of talk about the market being afraid about interest rates and about rising interest rates and about the Fed and everything, but you actually don't see that in the market. I mean, the market is not selling off. The market is, you even see it in the performance in Australia. The so-called reflation trade has not performed in January and in February, and the stocks you shouldn't be holding, the high PE technology stocks and the healthcare stocks, they've outperformed the rest of the market. So,
but there were some earnings fundamentals that came through to support some of those healthcare stocks. That's
true. That is true. But the ruling view was that you should sell those stocks. You shouldn't own them because interest rates are going up. So the irony is that those stocks actually have outperformed, including the healthcare sector, which is one of the best performers in Australia. And so to me, that also tells me that the market is a lot more comfortable with how things have been going thus far than a lot of commentators would like us to believe.
Well, then let's bring in Chris Conway from the Australian Stock Report. He's joining us live from our Melbourne studio. Chris, I'm curious to pick you up on that point, because wouldn't it make sense that we are in an environment of rising interest rates, particularly in the United States, given the strength of the economy? I mean, we saw more data out through the overnight period that does certainly support a return to normalized interest rates.
Good afternoon, Nadine and team. Yes, look, I would agree that probably given the data and some important data that's likely to come this week, that we may see the Fed raise faster than previously thought, and that affirms what Jay Powell said a couple of nights ago. I'm a bit surprised that markets and indeed long-term players aren't a little bit more worried. Not necessarily about the rate of hikes, because the Fed has been telegraphing them nicely, but it's about the probability that the Fed gets this perfectly right, and that's what they need to do. So if they raise quickly, because the US economy is performing really strongly, then the casualty there will be the stock market, and that will probably be the lesser of the casualties, and I think the Fed is prepared for the stock market to be a bit of a casualty. If they get it wrong and they raise too slowly and a bubble forms and that bubble is allowed to burst, then it drags the whole economy lower with it. So, like I said, I'm just a bit concerned that we're all a little bit too complacent that the Fed is going to get this perfectly right, because that's what they need to do. Otherwise, the stock market or the economy more broadly is going to suffer.
But how much will the stock market suffer again? Doesn't it come back to earnings? Because we have seen, I think it's 70-something% of S&P 500 companies beating on expectations.
No, it's actually not just about earnings. It's actually not just about the economy. It's actually about liquidity and PE ratios. I mean, yes, if bond yields have to rise faster than we all anticipate, then the share markets will have a correction. That's without any doubt. We only have to look back at 1994, when both the bond market and equity markets globally incurred losses in portfolios. But that's still on the assumption that bond yields have to rise further than the market at this point is anticipating. And so it's not just about earnings; it is about bond yields here.
Yeah.
And there is even amongst the experts, there's no view here that has a middle of the road here. Now you're either a bear or a bull, and the battle lines are really sharply drawn. I mean, there are people talking about 4% by year end. There are people, and I'm actually at this point in time more in that camp, that actually think that most of the moves in bonds for the time being have been made.
Adam, want to weigh in? I mean, we did see U.S. stocks suffering their worst month since January of 2016. It certainly seems that at the very least, we'll have some increased volatility. We saw it in the last hour or so of trade in the U.S. today.
Last night, yeah, definitely. I think volatility is here to stay, and we've just got to sort of become used to it. Last year was very
abnormal.
Steady. Yeah, and sort of low returns, low volatility. I think we're going to get high volatility this year. Yeah, I sort of think it does come down to those bonds and where they sort of sit. Our analyst macro guy, he's sort of talking about that short term we're sort of okay, but for sort of midway through to end of this year we're going to have to lift up our cash positions. So short term we're okay, but yeah, longer term I think there's a fair bit of uncertainty in the equity markets.
Nadine, it's also probably important to point out that at this point in time, bond yields are like the oil price. Huh? When they rise at first, just like oil price, that's positive. Mm-hmm. It just becomes when they rise too far or too fast, that's when it becomes a problem. Yeah? Nobody complains when the oil price goes to $80, for example, but they do complain when it goes to $100 over 2 nights. Yeah? Mm-hmm. Because then the consumers don't have time to adjust. And it's the same with how rising bond yields. I mean, if this environment remains as it is right now, there should not necessarily be a problem for equities, because so far, I mean, there's no reason why bond yields should sprint to the upside. But if they do, of course, then we will have a sell-off in other assets.
Okay, look, we'll talk more about U.S. in the next segment. Chris, now that we have you here, I'd like to get your thoughts on some of the companies that you're keeping your eye on today. We've had Orica coming through with the profit warning. Was the blow softened at all by the company's talk around cost cutting and savings coming through there, likely in FY19?
No, I don't think it was, Nadine, for a couple of reasons. One, they didn't provide a great amount of detail other than to say a few jobs would go. So, yeah, I don't think they provided enough clarity for it to really have a material impact. The other thing is it's only in the magnitude of $30 million, although they think that will be repeatable year after year. Balanced against the write-down today of $400 million. No, I don't think it does enough to soften the blow. But then again, we put this $400 million write-down in context. 55 of it was tax, 300 million of it was related to the Minova mine, which is struggling operationally. Orica have already taken a run at trying to fix it. They've changed the management team once, but that hasn't seemed to work, and I think it's still on the chopping block. So, yeah, in context, Orica's revenues each year are about $5 billion. 400 million to write down isn't too material.
Orica, any view on Orica? Adam Dawes is down by, pretty close to 4%.
Yeah, it actually opened at 17.46, so it's actually come back a fair bit from the open, but still down, definitely. This is a really tough one. They've said that profit warning's tied to plant reliability. Mm-hmm. They really should have these things pretty much under control.
You would think. I mean, they didn't report that long ago. You would think that they would have known that this was in the works.
Absolutely.
The prospect of it, regardless.
So it's disappointing, obviously, to see that starting to come through. I think the market's, obviously looking at it now, the market's taken to it, but closer to $18, maybe it's sort of fair value there.
Yeah.
I think anything over $20, it's a sell. So I'm sort of comfortable here.
Rudy, come on, weigh in.
Bear in mind, Orica did not report in February. They report out of season.
They didn't. Well, then good.
They report out of season. So this is obviously, they're preparing the reports, and this is obviously coming to the surface. This is a pre-warning. The one thing I have to say is I don't like it. And it also shows you the danger in investing in the share market from a macro perspective, because this is strictly taken a mining services provider. And this is a sector that is very much loved by investors. But you see that on a micro level, often those stocks don't live up to expectations. And Orica is one of them that hasn't lived up to expectations. And I don't think it will in the short to medium term.
Okay. Now, also on your list of things you wanted to talk about, Chris Conway, Domino's Pizza. So this is a company that, boy, has been generating a lot of headlines lately. Perhaps not much the company as its founder and head, Don May. Where do you sort of see the company going forth from here? I mean, very high expectations clearly for the second half, but also, I mean, this sort of controversy, if you can call it that, surrounding the company doesn't really do much for confidence, does it?
No, it was a market darling at one time, Nadine, and now it's fairly on the nose. The company has come out with 4 announcements to the ASX in as many days. So a lot of the talk recently they've generated themselves. And you've got to make that many announcements, things aren't probably going fantastically well. Don May, in the results recently, reaffirmed the 20% profit growth guidance for this financial year. In order for them to achieve that, they've got to have a sales growth figure in Australia and New Zealand of about 11%, and that's essentially from the start of February until the end of June. In the first half, it ran at 3.7%, so they've got to cycle really, really hard to make that number, and I just don't think that they're going to be able to do it. Stock has fallen pretty sharply of late. It was 50 into 40, it's sub 40. We're still selling it this morning though. We think there's some further downside. We just don't think they make those numbers.
All right, Chris Conway, Australian Stock Report, thank you so much for joining us. Appreciate it.
Thanks, guys. Cheers.